Welcome everybody to another Bond Boot Camp. I'm Marilyn Cohen, President of Envision Capital Management, and this is Alex Anderson, who is our head trader and municipal bond analyst par excellence. Alex, I wanted to have this little conversation today because so many do-it-yourselfers fall into a quagmire as to what they should buy, what we have seen them do wrong. And you've been with me for 11 years now, and we have looked at a lot of muni bond portfolios from do-it-yourselfers. Mm-hmm. What have you seen that is really a pitfall?
Well, a new pitfall is general obligation bonds. This is a relatively new phenomenon because of all the pension liabilities that these state and local governments have undertaken. So now we've moved towards revenue bonds.
Well, that's a good point, because when I was young and started out in the business many years ago, GOs were the holy grail. And now your point about unfunded pension liabilities is really a great point. What other things do you see?
Back to the revenue bonds, we really like airport bonds. We like water and sewer bonds. Steady streams of income. We like bonds from very affluent areas and mature areas, coastal areas, especially here in California.
Well, one of the things that I've seen that do-it-yourselfers do incorrectly is they look at the rating agencies and think that is just the Bible of buying bonds, and they count on insurance. And I don't think you can count on either one. And we have seen people load up on the same kinds of bonds year in and year out, and just because they get away with it now doesn't mean they're going to in the future.
Absolutely. You can't rely on the rating agencies alone. They barely ever look at individual municipalities. So what we need to do is we need to look at the actual financials that are issued by those municipalities to make sure we stay on top of their financial condition.
Well, that's a good point. And even to expand on that good point is the fact that so many times people don't look at their financials. They buy a city bond that is a very small city. We had a potential client come in with a Pennsylvania bond, and the population of the city was 15,000. You looked up who the taxpayers were, and drum roll, tell the audience who they were.
I believe it was a mining company, paid about 70% of the tax for that particular municipal bond.
So the mining company has problems, revenues go down, interest coverage on the bonds goes down, the bonds get downgraded, and bada bing, you've got a quagmire on your hands, meaning lower prices and maybe no exit in sight.
It's very interesting you say that. Yeah, it's really important to look into those financials and look at those little things, like who are the principal taxpayers? How much of the tax burden do they pay? Because these little things can really affect your investments.
And what we're seeing now is people need to take in consideration the gigantic footprint of Amazon. You buy a city bond and it is reliant on a couple of major malls, retail malls, and those malls get Amazoned, meaning the leasees go out of business, whether it's Gap, whether it's Victoria's Secret, whether it's Sears, whether it's JCPenney's, and where is the revenue coming from in order to pay you your timely interest and principal? So I think that those are a lot of the big potholes that retail investors get themselves into. I'm Marilyn Cohen.
I'm Alex Anderson.
Thanks for joining us.